I think the step we have to make now, building on what Michael Gratz and Mike Devereux have said, is that we have to transform the underlying fundamental question, whether we need a corporation tax at all, into the more specific question, as long as we do have corporate income tax around the world, how to allocate different items of income to different jurisdictions. Because that's what the BEPS process was about, that's what the BEPS process sought answers to, and that's what comes up immediately once you try to implement all those requirements which have been laid out by Michael and Mike, incentive, compatibility, efficiency, etc. So what are the standards to be applied? What are the benchmarks to meet when it comes to international profit allocation? Now, we have to think about normative criteria here for international profit allocation. The most prominent, which has been mentioned in recent years, is fairness. Multinationals being obliged to pay their fair share. Now, just to give you a brief notion of how insecure that is as a benchmark, are we talking about fairness between different taxpayers? Small domestic companies versus multinationals? Are we talking about the fair share between the taxpayer and the country he or she or it resides in? Or are we talking about a fair allocation of taxing rights between jurisdictions? Something Peggy Musgrave has called interjurisdictional equity. So these are three different criteria of fairness which might not go to the same direction. We have talked about efficiency. Mike Devereux has mentioned it, but the standard is very unclear. You are pretty aware of all the discussions about different neutralities, CEN, CIN, CON. David Weisbach had a paper last year out on the rather limited use you can make from these neutralities, because it's not clear which one to give priority to. And that very much feeds into the next bullet point. Would efficiency, would neutrality be judged from the basis of a single country or from a global perspective? As a matter of fact, when you sit together in a group of 7 like we did in recent years, sometimes you move yourself into the position of a benevolent dictator of the tax world and think about the overall system. But as Mike rightly said, you have to get everybody on board. You have to get single countries on board. They have to see a benefit in the proposals you make, and unless you cannot convince a lot of different countries around the world of what you are thinking of, this will not work. This also leads into the questions, to what extent do we accept tax competition? That's a debate that has been around since the late 1990s. Is there a dividing line, a meaningful line between harmful and fair or sound tax competition or not? And that is also very important for the standards you are going to develop. In the end, I would fully subscribe to what Mike Devereux just said. Having incentive compatibility in place is extremely important. Countries must see a benefit in what's going on. Now, one technical issue here, allocation of profits is very much related under current law to allocation of taxing rights. You've got the multinational, you allocate profits to subsidiaries, to the headquarters, the parent company, to PEs, and you follow taxing rights from that position. That's not necessarily automatically so. It's also possible, as you see under formulary apportionment and as you see under, let's say, withholding taxation, that a taxing right in country A is asserted on behalf of a company in country B. But the current system very much links the allocation of taxing rights to the allocation of profits to different entities in different locations. Insofar, the notion of parent, subsidiary, permanent establishment, etc. are here at the forefront. There are, and that's another carve-out I would like to make, there are some situations, some problems addressed by BEPS, which are not really problems of international tax allocation in the sense we are talking about. And those are tax arbitrage situations, like, for example, the hybrids. If we have a deduction in country A and an exemption in country B for the same financial flow, that has basically nothing to do with the work we are doing here, because that's an arbitrage situation stemming from qualification conflicts and similar situations between countries. And the transfer pricing problems we have with Luxembourg and the Netherlands and some other countries largely relate to a situation where profit allocation in country A is simply out of sync with profit allocation in other countries, so that in the end you are taxed only on 80% or 70% of your overall profit. I will not go into that. So what's the status quo according to the OECD model in the pre-BEPS era? You have a division of taxing rights on the basis of residence and source. You have no specific profit allocation rules for intra-group income. That, I think, has always been remarkable. All the rules we have about PEs, about interest payments, royalty payments, transfer pricing, etc., they all try to treat group companies like independent companies. It doesn't make a difference for the application of Article 11 on interest allocation to the residence country, whether you get your money from a related entity or not. It's simply taken as a given. And what we see currently coming up in the BEPS process is that this fundamental notion of treating intra-group transactions like extra-group transaction is gradually being eroded. Look at action item 7 on the avoidance of PE status. We now start for the first time to have specific allocation rules for intra-group transactions as opposed to independent transaction. And the arm's length principle went into the same direction, promoting equal treatment of dependent and independent corporate entities under international tax law. So the basic assumption of the law as it stood before BEPS was that transactions and profits within a corporate group are treated exactly the same way as outside a corporate group. And that is the consensus that has been under attack for a couple of years now. Now, the critique of international tax allocation under the OECD rules has been threefold, and I think it's one of the major analytical problems of the current debate that these three lines of critique, which are completely different from each other, are mixed up in the policy recommendations and to a certain extent also in the academic debate. Well, first of all, we have this overall debate on division of taxing rights between industrialized and emerging or developing economies. That is the major question of the 21st century. To what extent the old, rich Western world will give up taxing rights vis-à-vis emerging countries and developing countries. And that's a major question which also refers to the division of taxing rights between production countries and market countries, because countries like India and China, they assert taxing rights on the basis that they have a strong customer base, that they contribute to the profits being made by the multinationals, and insofar they want more money from the overall transactions. But that's a discussion completely different from the one which was the starting point of the BEPS debate. And that's the division of taxing rights between industrialized, emerging, developing countries on the one side, and tax havens and countries entertaining preferential tax regimes on the other side. That largely relates to financial income, to intangible-driven income, because that's what you can stash away in those tax havens. But it's a completely different dividing line, a completely different conflict when compared to the one between industrialized and the developing world. And then we have this academic and practical debate under bullet point 3 that people tell you within a multinational firm, it's simply hard to apply rules which have been designed for independent taxpayers interacting with each other. Because the theory of the firm tells you there are synergies, there are value chains, you have these highly integrated multinational entities crossing borders, and it's extremely difficult, even if you had a wise and robust starting point theoretically, it's extremely difficult to allocate profits within a highly integrated enterprise to different jurisdictions. But those are three different questions, and all three have to be addressed by what you are aiming at. Now, what are the basic reform proposals for international taxation? We have the BEPS project, which is still underway. We have formulary apportionment, and the most prominent example is the CCCTB project put forward by the European Commission. We have, and I simply named it Obama, we have this idea of an extension of worldwide taxation towards a worldwide minimum tax, and we have the DBCFT, the destination cash flow tax, which will be talked about in a later session today. So I will focus now on the first three we have here on board. Now, the underlying theory of the BEPS project was and is to align taxation with value creation. And that was very helpful as a starting point to attack tax havens and preferential regimes. Because what you basically do not see in tax havens is exactly that, value creation, economic activity. On the other hand, this idea of aligning taxation with value creation, and Mike and John Bella have written a marvelous article on that, is not a solid basis for overall revamping the tax regime. Interest and royalty income under the OECD standards is not allocated with regard to value creation. If you want to allocate business profits between production country and consumption country, it's hard to say which side of the market contributes more to value creation. You've got huge problems to identify value creation in huge multinationals where you have R&D here and headquarters there and production over there and distribution services over here and bookkeeping and standardized and shared services and cost contribution schemes, etc., to really apply a vague and general standards like aligning taxation with value creation to that is extremely hard to do. Where does this lead? Under current proposed and implemented rules like action items 8 to 10 of BEPS, it leads to aligning taxation with activity, meaning presence of people, meaning counting people present in a certain territorial jurisdiction, and the notion of you only are allocated risk-related profits if you control that risk. If you want to control that risk, you have to put people there. So it's basically moving into a sort of profit allocation by counting people and their salaries. And that is, of course, another major source of future activities and tax planning activities. How many people do we need to move to Ireland in order to have a meaningful control function there in place? In the end, the whole idea of aligning taxation with value creation is wedded to the benefit principle. The country seems to support the activities by doling out public goods, and that, as Mike said, is a very, very shaky starting point. Now, is it better to move towards formulary apportionment of international business profits? That's the CCCTB project. And it has basically two really good outcomes. Number one, all intragroup dealings are largely rendered irrelevant. Debt equity distinctions within the group, nonsensical. Intangible allocation, irrelevant. Central service functions, the cost will be spread all over the multinational, and you have a built-in cross-border loss compensation. So that's very good. But it has its drawbacks as well, and these are very well understood and very well known. You have discrete outcomes for related and non-related business entities. So you have a large company like Siemens, they have a small independent supplier of software, and currently they are taxed on their respective profits. Once Siemens decides to buy that supplier, it will be part of the group and the whole profit allocation will look different. So the make or buy decision will be influenced. You've got problems of legal and factual optionality. As long as you do not have a worldwide single formula, there will always be option to interpose third country subsidiaries in order to live in different worlds. You will go on and strategically allocate production factors in order to game the formula. So you will put a lot of, let's say, people in a certain low tax jurisdiction if payroll is strong in the formula, and so on. And in the end, the CCCTB project is built on the assumption that all participating countries share the same formula. That's different from the US situation, where every state has their own formula, and insofar there will be huge political pressure on the choice of formula. I do not know where that will end, but for example, between Germany and Poland, it is clear if you have a labor factor, Germany will look to the payroll and Poland to the number of employees, and that will be completely different in the outcome. Now, what about the US thoughts about extending unlimited tax liabilities for corporate entities? Would mean giving up territoriality for dividends and profits generated in permanent establishment, would extend CFC legislation. It would have a good effect in rendering tax havens rather unattractive because the profit cannot be stashed away that easily, but it will increase the relevance of the parent company's residence because that will be the decisive point for the overall taxation. Where is the parent company located? And when you look at the current US debate about inversions, about competition for holding companies, that pressure will increase to invert or to migrate to another country to get out of the scope of that worldwide taxation. You would have to discuss again with source countries the division of taxing rights if you want to assert more worldwide taxing rights. And with respect to what Mike just said about corporate taxation, the corporate seat of the parent company is not anymore a meaningful proxy for the residence of the shareholders. Insofar, one should not put too much stress on that. The new options, which will be discussed later, destination-based cash flow tax, residual profit allocation, I will not go in. Just 5 small remarks to finish. There are no fixed principles of international tax justice to apply here, and there are no fixed principle of international tax efficiency apart from the very general but very important plea for incentive compatibility, which Mike Devereux has put forward. There are 3 things which a lawyer would like to see emerging from the process. We need to proceduralize the process. Otherwise, there will be chaos because each and every country will simply look for their benefit, and there will be a re-emergence of double taxation situations if each and every country starts from scratch defining their own interest. We have to rationalize the fight over taxing rights because there will be interconnectivity of domestic tax system. So what country A is doing has to be connected to a certain extent with what country B is doing. And we have to simplify the fight over taxing rights. So we need a common terminology, common practices. That is, for example, what we are going to lose when we simply go to very fuzzy standards like fairness or aligning taxation with value creation. That's it. Thanks.